we have 27 people, about 50 billion of assets, or 54 individual assets. So that's you can do the math.
Okay. Episode 15 of The Deal Ranch. Kellan Florio, thanks for jumping on.
Pleasure to be here.
Well, pleasure to be here in your office. Thanks for the invite. It's quite a nice setup here. So, Chief Investment Officer of arguably the greatest real estate portfolio, I think, in the world, or at least one of them, right? You guys own every big name property. I'm sure there's still some that you guys don't have that you want, right? In Las Vegas, the Venetian, Caesars, MGM, the Mirage, and then in total 54 casinos, 4 private golf courses, and then we can talk about Canyon Ranch and all the other experience-esque assets that you own as well. But thanks for coming on. Looking forward to hearing your story through Goldman and then what you guys do here at VICI Properties. But you can introduce yourself. I would love to hear it.
Sure. Yeah. Matt, thanks for coming and happy to be on the show.
Yeah.
As you mentioned, I'm the Chief Investment Officer of VICI Properties. We can get into who we are at VICI and what we're up to and a little bit of the history.
Yeah.
It's a pretty interesting short history of VICI Properties as a publicly traded real estate investment trust. My background in the world of finance and real estate kind of goes back to a earlier chapter in my career where I was an investment banker at Goldman Sachs. So I spent really my first 17 years out of college as what they call lifer. At Goldman. Spent a lot of my life at 200 West Street and 85 Broad Street as an analyst, as an associate, as a vice president, as a managing director, all within the real estate group within investment banking. So working on transactions that involves capital raising in the public markets and the private markets, mergers and acquisitions, spinoffs, restructurings, kind of all the things investment bankers do.
That you would think,
got to do within real estate, gaming, and lodging for many years.
Wow.
Yeah.
So you went to school at Middlebury, and did you play soccer and was there a ski team as well?
There was a ski team. There still is. It's pretty good. It was a little too good for me. So I was a multi-sport athlete growing up, and eventually soccer and alpine ski racing were my two sports. Grew up in New Hampshire, and Middlebury is a Division I ski program.
Wow.
Division III at every other sport. So I played soccer all 4 years. Ski raced my freshman year, and was politely told after freshman year that you're just not quite going to cut it for for the varsity team next year. So that was the end of the ski racing days, which was all good. I was my best friends were on the ski team and guys that were either former or aspiring U.S. ski team athletes.
Wow.
So I wasn't quite at that caliber, but still like to shred it a little bit at 40 years old.
Absolutely. Any big injuries during the career growing up?
No,
it's a big injury.
Yeah,
sport.
it is. I was lucky to avoid all the typical injuries as a skier. And frankly, as a soccer player, I had my fair share of knee sprains and ankle sprains and the like. But the biggest injury for me came several years after college, and I was probably one of my typical days grinding it out at 200 West Street at Goldman, and jumped in a cab on my way uptown to play in the soccer league.
No way.
Tore my ACL. So that was 2011.
Wow.
Yeah.
Interesting. So when you were in school, obviously a great college, what was the plan after school? Was it always like, because a lot of, I guess kids, however you want to say it, that go to like these premier colleges, like they already kind of have a path in mind. A lot of folks do, right? And investment banking being very popular now, but has always been popular and very prestigious. Was that always the plan? Was it, I got to go to Goldman? What was it? Like, what was the plan?
There was definitely no plan.
Okay.
No plan at all. I knew what I liked.
Which was?
I knew what I was good at. I liked math and problem solving and analytics and the like. But I went to Middlebury as a liberal arts student with a major that was going to be very liberal artsy.
Sure.
Not a finance major.
Right.
I could have gone to other places but I didn't know I wanted to go into finance.
Yeah.
I started to learn a little bit about it through economics courses, and in fact, I didn't even know what Goldman Sachs was. There was I'll never forget, there was a kid by the name of Len in my freshman macroeconomics class who had already done an internship at Goldman Sachs
Oh, no
before
way.
even starting at Middlebury, and he was on his path, and I didn't even know what investment banking was. So learned a lot
Sure.
in college, and kind of through that networking, as you do, you build an understanding of what you like, what you're good at,
Absolutely.
who can help you, and found my way to Goldman after Middlebury.
So did you go the intern route in one of the summers and then go on full time, or did you just go right to like an analyst
at Goldman,
role?
But I back then it was a high conversion rate from internships to full time offers, but it wasn't as high as it is today, where you have to do an internship. Back then, it wasn't quite. So I was studying abroad as a junior spring and sort of missed a lot of the internship interviewing periods and. I got home from studying abroad in June of 2004 and pounded the pavement and got an unpaid internship at a local asset management firm. That was my experience that I somehow parlayed into a full-time offer in my senior fall at Middlebury. But a little bit of a non-traditional route and one that you can't really do today. Maybe as a freshman in college in your summer you can do that, but not as a junior.
Sure.
Yeah.
So you go into equities analyst role. Like, what was your initial walk me through like the initial days there. Obviously, you hear all these stories, and there are a lot of books obviously out there, and just what investment banking life is. But what were the kind of initial days there, and then how over time did that progress? Well, I guess we can talk about your sabbatical too, but how did it progress early on? Like, did you know real estate was going to be an option, or like what were the first couple of years?
Yeah, the role I took at Goldman at the beginning was not within the investment bank. It was within the equities division, or what people like to call sales and trading. So it wasn't real estate specific. For me, coming out of Middlebury, it was an opportunity to work at Goldman Sachs. Yeah. I could have gone to different banks and done different things, but this was an opportunity to work at Goldman Sachs. So I chose the firm over the role.
Of course.
The role I had was very markets focused, very equity markets focused. It was a group that was linked to our New York Stock Exchange trading business. So it was an interesting time with the New York Stock Exchange, where it was at the time was just on the beginning of converting from a analog marketplace to a digital marketplace, or an electronic trading platform.
Sure.
And so this was 2005 when I started. So 2005, 6, and 7 was a time of tremendous growth in the economy and tremendous deal making. If you're an investment banker, it was a time of tremendous decline if you're a market maker in the New York Stock Exchange. Yeah. So it was a really interesting vantage point on how you can have a sort of a dichotomy in the world of finance
under the same roof.
Double click into a subgroup. Yeah. So I learned a lot. I learned a lot about the markets. Learned a lot about about different industries, and got to have direct relationships with a lot of our listed companies. But I knew that it was a role that was going to be short-lived. It was a good kind of crash course, but investment banking would be a place that I wanted to move to get a much more broader lens on corporate finance.
And did you were just kind of betting on yourself in that, like, hey, if I get my foot in the door, I know I can make the jump over to investment banking? Or,
I had known when I decided to take the role at Goldman, I knew that investment banking was a place that would make a lot of sense for me to be. Yeah. I didn't have like an absolute North Star that I had to be there. Sure. But I did realize in those first year or 2 years that it would be a great next step.
Yeah, cool. So before we get into like the 2008 part, how did the sabbatical and in taking time off? Because a lot of people don't do 2-3 good years at their dream jobs, so to speak, and then leave. But you went overseas to South Africa?
That's right. Yeah. I mean, the quick background there was I had I spent the 2 years, almost 2 years, doing the sales and trading type of role. Yep. I moved to the investment banking team within real estate. Got it. Spent a year, and then I took a sabbatical year. Yeah. I had sort of dabbled with a specific organization called Grassroots Soccer as a friend, as a helper, I wouldn't even say consultant, but as an organization I got to know. I was a soccer player in high school and college, and one of my teammates had actually gone from Middlebury, had gone to work for Grassroots Soccer after school. And I was following what he was up to in Botswana and South Africa and Tanzania and doing all these cool things, kind of giving back to these local communities and doing amazing work. And here I was not helping the world.
In a different way. Yeah.
So for me, it was a little bit of how can I do something to me that feels very meaningful? Sure. In the grand scheme of philanthropy, not as far as giving money. I was 3 years in Wall Street. I was not, right. Not having big donations, but had a sense of awareness, I guess, in the world. And felt like I could have an impact in a different way. And so I really just tried to have my cake and eat it too. So I was thinking about going to business school, but ultimately negotiated with my team and said, look, if I take a year off and do this nonprofit work and come back, will you honor that? Will you let me back?
Wow.
And they did.
Really?
They did.
That's a unique jump. So then what year did you come back? 2008 or 2000?
So I started in the investment bank in investment banking division in real estate in 2007.
Okay.
I finished that year in 2008, and then I returned in 2009. So I spent the 2008-2009 year in South Africa working in a completely polar opposite type of world than on Wall Street, and it coincided with the great financial crisis. So I like to say that if I had stayed in my role and stayed working in real estate investment banking at a time when deal making and CMBS issuance and all the things that impact commercial real estate, declined by 90%, I might have been on the street.
Wow.
A lot of people got laid off or repositioned.
That's right.
That's
what they
so
say.
I was really lucky, and by the time I came back in the summer, it was July of 2009, our team was working on Simon Property Group's debut investment grade issuance post GFC, 10% coupon, the DDR TALF CMBS issuance. These were reopening the markets, and here I was coming back saying, "Hey, what's everybody all nervous about? Everything seems fine."
Yeah, what's going on? Yeah, what I miss. So when you come back, there's still these additional 15 years that you're still at Goldman, or another 14, right?
There's a longer story to it than the early years. Yeah.
So after you come back, you're already in on the real estate side. Is that also coinciding with the gaming / experiential real estate? When do those all come together, and how does even someone learn about that? Like, it seems like for as large as the assets are in the gaming space, to me, it's not like this mainstream asset class that people hear or think about, just because there's such a capital intensive barrier to entry almost. That it's niche from the outset, but in reality, the assets are so big that it doesn't seem really much of a niche. But how did you get involved in that inside?
Yeah, so if you think about almost a pyramid, if you will, I was at the base of the pyramid as an associate in investment banking, not just in terms of you're more of a junior role, but you have a very wide breadth of involvement in asset classes and deals and everything. And over time, you tend to narrow into something that's more of a specialty.
Interesting.
So as an associate within the real estate investment bank, and think of real estate as one of 8 industry verticals across investment banking. Most banks are set up that way. Okay. So real estate covered everything from hospitality, leisure, gaming, so anything involving casinos, including the technology that goes in the casinos. And today it's online and sports betting. That's part of gaming as well. And then all things commercial real estate. And so it tends to be more publicly traded REITs or large sponsor-backed portfolio companies, or even entrepreneur-backed businesses. Single asset stuff isn't really what we would do in investment banking, aside from the debt financing side of the business. But as an associate, I supported teams across all those different verticals. So I worked on multifamily REITs and office REITs and diversified REITs and net lease and anything that touched hospitality operations. So the Marriotts, the Hiltons of the world, to the REITs, to timeshare companies, to the casino operators, the Native American casinos in some cases, slot machine manufacturers. I kind of covered the breadth, and over time, from an associate to vice president and eventually managing director, I sort of narrowed my focus really to gaming, lodging, and leisure, and then I ultimately ran the lodging and leisure side of the business, which is crazy, as a managing director.
That's not a path that obviously many people can go. There's only so many people at Goldman Sachs. Everyone aspires to be a managing director, but not only so many can do it, right? What was the hardest part, or what is day-to-day life like in that journey? I'm sure that's the outset goal, right? Everyone wants to be an MD, and that's not where everyone always ends up. But what do you think, looking back, was the hardest part? Is it just purely the hours? Is it, in some bit competing against your peers? Is there what do you think was the hardest part about making it to that level at the company, but also providing good quality work for your clients too? What are the hardest parts along the way?
I think each role, each level, from the analyst level to the managing director level, each has its own idiosyncratic challenges.
Got it.
But I think the overarching challenge along that progression is being nimble. What makes you a good analyst doesn't necessarily make you a good managing director. What makes you a good managing director doesn't necessarily make you a good analyst.
Sure.
So you have a job to do as a managing director, and that is be the thought leader, the client relationship leader, the product expert.
Yeah.
But you don't necessarily have to be as deeply in the weeds and analytical about things that maybe you were when you were an analyst. So being able to take a skill set and the base that you learn at the junior level, apply it to the next, but also kind of pick your head up and understand, the bigger picture around it and the client relationship angle. So, I mean, it's very similar to lots of other industries and careers where you start at a broad base and you kind of sharpen some skills,
specialize,
and over time you specialize, but with the added benefit of having a little bit more autonomy, a little bit more, a little more freedom to kind of pursue where you think the opportunities are. And some businesses, it might be putting your own capital to work, and others it might be being the go-to strategic advisor to companies. But I enjoyed that transition from one role to the next, and each time you check in with yourself and say, okay, am I good at this next role? I think I was pretty good at the last one, but am I still good at this one? And what's the next one? Am I on the right track?
Sure. So how do, in the word deal can get thrown a lot around in a lot of different ways, I'm sure, in investment banking, but all of the deals or projects that you're working on are so complex. Any task you're doing for a client, so to speak, like because you're going after business in a multitude of different ways. How are opportunities coming to you? Are you going out and obviously kind of pounding the street and getting that? Is that start more in the analyst role, and then on the managing director side, is it just more strategic? But like, how long do deals take to happen? Like, what is the process for them to originate in the IB space? Yeah, or for gaming.
Origination of deals is really origination of relationships.
Yeah.
Any transaction that we worked on, or any deep strategic review analysis we would do, whether or not it ever saw the light of day in an announcement of a deal, those started with a relationship. And the relationship generally starts with who's the senior member of the team that has the relationship with the CEO or the board member or the CFO at the client. And it's the role of that person within the bank to also institutionalize that relationship and not be the only source of that relationship, but enable the vice president on the team to have a relationship with their counterpart at the client. And so that was one of the evolutions of the role. So becoming more of an expert in a category and understanding the landscape around my more narrow client set allowed me to be in a position of having, developing relationships, not just on personality, but on content, right? That you understand their business, you understand their peers' business, you understand their competitive threats, you understand their opportunities, and you can give advice, not just on, the tactics of executing a bond deal, but of how to look around corners and think about what acquisitions might help position the company for the next wave of growth that might be coming, or how to think about their, if they're a publicly traded company, why might their valuation be discounted relative to some of their peers, and what can they do about it? Yeah.
So a consultant in every sense of the business, you're almost working for them just as much as you're working for Goldman at the end of the day.
Well, at the end of the day, they're the ones that pay the bills, right? So you are working for them, an employee of Goldman Sachs, like any advisor, like you're employed by a group, but you're only relevant so long as you're relevant to the client.
Yeah. Yeah, that's a good point. So kind of with that mantra, right, how did these relationships at the peak here in the MD role, in the gaming space, how did that end up with you making the transition to VICI? And then we can give an overview here. I would love to hear in your own words. But like, how did this chief investment officer role come around? And were you working with these guys before in a different way?
Sure. Yeah. I mean, going back to the R word, right? Relationship. Yeah. So as an advisor at Goldman, was able to work with companies like VICI. And VICI was somewhat unique in that that was a company that was just formed out of thin air. Yeah. Right? It was a spin-off.
2017,
real estate.
2016.
Yeah, and we can get into the formation of it, but that was a company that I got to know from literally day one.
Oh, wow.
So the company was formed. They were formed out of one of my clients, Caesars Entertainment. Yep. And therefore they became my client. myself and some colleagues as well. But so I got to know them from the beginning and help them sort of develop a little bit of their business strategy, their pitch to the investment community, and help them do some of their early capital raises in the debt and equity markets, including their IPO. And when you're, I compare it to almost like being on my college soccer team, right? If you played sports or folks, but when you're in the trenches with your teammates working on, whether it's, doing the last sprint in practice or, you're gutting it out in the 90th minute to try to lock down the win. Like
absolutely,
you build these, you build these bridges, these relationships that are based on being in the trenches together. And I had a lot of that with a lot of my clients on big, important deals or just thinking through difficult challenges. You build relationships.
Absolutely. Well, this very strong bond going through any of these challenging scenarios, especially in your business where high stress, very, very high monetary value. People are working all hours of the day. I'm sure there are some strong bonds built in that process too. Especially if it's successful, right? The project you're working on.
Yeah. But look, even some of the deepest relationships you have are born out in the tough times too.
That's right.
I always like to think about anytime you have to give a client really, really bad feedback or have to approach a really tough subject. It's a character building moment.
Absolutely. I'm sure that's how you pitch it.
You hope to look back and say, that really, really hard conversation we had to have, well, it made us stronger.
That's right. We're friends now.
Selection bias. Maybe there's a few that didn't go the right way, but VICI was definitely one that went the right way. It was not that there were like really tough times, but it was the formative years of a brand new company just emerging from a bankrupt entity of Caesars. So it was sort of great fertile ground for relationship building.
Yeah. So before we kind of dive further into VICI, for anyone listening, and for a lot of people obviously don't know how the real estate arm of Las Vegas functions, and you guys being a majority owner of all property in Vegas, but you have all these large assets, all these large casinos, right? 54 in total. But do you want to break down the PropCo-OpCo structure, right? You guys own the land and the buildings, and then we have all these other companies, MGM, Caesars, that are the operators. But and then the REIT structure as well. That maybe
sure. Yeah, our business, on a simple level, is a triple net lease model.
Yep.
Triple net lease simply means that the operating company is the tenant.
Yep.
They're typically in single tenant buildings where the tenant pays rent to the third party, to the property owner, the PropCo or VICI in this case. And on top of paying rent, they're also paying all other expenditures that are required to occupy that property. Insurance, real estate taxes, maintenance capital, etc. So it's about the most passive form of real estate ownership as you can have. In a lot of ways, it's a financing structure. So triple net leases exist somewhere on the continuum between traditional commercial real estate and secured financing.
It's interesting. And then also in that, right, there's a plethora of different ways you guys structure the deals, and especially with Canyon Ranch, where there's this option to buy the asset later too, which is kind of unique. So we can talk about that. But before I forget, how did you... So obviously you went through the structure of helping them probably formulate the REIT, VICI standing it up. But how did you end up getting the role? Like how long did that courting process take, or what interested you about coming here? You're in this really pivotal position where a lot of people, like you said, are lifers at. Like once you become MD, maybe people don't leave, or they do it for a very, very long time, or maybe they try to keep going. But what made you want to leave, and what attracted you most about going to VICI?
Yeah, so I a few things.
Yeah.
VICI, so the company was formed in 2017. Think about the timeline. I joined in 22. So the company had been around for 5 years. And over the course of those 5 years, I worked with them quite a lot in everything from helping to raise capital and advise around strategic situations, but also just to help them think about growth verticals. So the company... This is a little bit into the VICI origin story. Is VICI was started as an owner of Caesars casinos. So we had one tenant, we had 18 properties, really under one big master lease. Really technically two, but back to Caesars in 2017. But the mission of the business was always to invest in adjacent or experiential properties. So casinos, and for a variety of reasons, were sort of ripe for morphing into this OpCo-PropCo structure. But there are a lot of other categories that exist within what we call experiential real estate
Sure.
that we felt, and I say we because I was helping them think through this at the time, but just that should be available to the idea of an OpCo-PropCo structure. And so a lot of the time I spent with VICI over the years was just helping them think through what are the adjacencies and what are the opportunities and who are the people, how to assess them, how to evaluate, how to get in front of these ideas. Almost an outsourced business development type of role. Which in 2021 was a transformational year for VICI. So in the few years that preceded, VICI had done about 10 to 15 billion of acquisitions, but in 2021 we announced about 20 billion of acquisitions, two major ones, the purchase of MGM Growth Properties, which was 17 billion, and the purchase of the Venetian in Las Vegas for 4 billion. And so in the span of a year, the company doubled in size. And by doubling in size and still being 99% casinos, really 100% at that time, the mission to grow into the adjacent categories and diversify was really crystallized. They needed to do that as a growth strategy. So they were at the point where they really needed to hire somebody to lead that effort. And I'd been, in some respects along for the ride all the way, and we had a great mutual understanding of each other. And and so they reached out.
So then, what is the extent of your role, or like what would you kind of highlight as your responsibility? So is it more on the acquisition and business development side, what we were talking about earlier before this?
That's right.
Branching out?
That's right. Okay. Yeah. We have 27 people, about 50 billion of assets, or 54 individual assets. So that's you can do the math. There's a lot of market cap per head. And there's only 3 of us that are really devoted to growing the business as our full-time jobs, our president, and then our vice president of acquisitions. And so I came in as our chief investment officer, as a newly created role, but really the mission for me was to think about the white space. So what is the white space? We're already in gaming. We're already big in gaming, and we're so big in gaming that there's probably not a gaming-related financing or M&A situation that VICI wouldn't have some opportunity to be involved in or know about or be contacted about. Just by sheer size,
touching everything,
and just reputation at that point. And the gaming world is small enough where people know each other.
Okay.
The white space was, is truly that, and is even defining what are the perimeters of that white space.
That's right.
And it's not just white space in terms of asset class and category, and what works within our experiential real estate thesis, but what structures of investing our capital allow us to penetrate some new categories as well, or allow us to deploy capital in ways that maybe we never thought about. So, for example, when we first started the company at VICI, everything was very simple. It was OpCo-PropCo, sale leasebacks. It was triple net leases, with single tenants. Fast forward to today, we've deployed over $2 billion of loan commitments. So we've got some loans that are mezzanine loans, some senior loans. A lot of them are funding greenfield developments. We've got some loans that are construction loans that will convert into real estate ownership. So when we think about white space, it's not just about what other industries and experiential categories to pursue, but what are the ways that we can position our capital deployment model to still deliver what we're ultimately here to do, which is deliver a consistent and yielding cash flowing profile to our investor base. They want visibility, they want stability, and they want it within the context of an experiential thesis.
So, for example, on the white space of these different asset classes, on one of the earnings calls, maybe Q1, Ed was talking about you, and he's like, hey, we hired Kellan, because someone maybe had brought up, like, would you ever get into the amusement park space, which is experiential, and maybe highlight a couple other experiential assets that are white space. But is that something that's on the radar? Like, what else would be? Because it's a very capital intensive or very large asset that almost fits perfect, and maybe a lot of them already are. And I know there's some REITs out there that do it too, but it's a very much OpCo-PropCo, just as you would think about it. So it almost seems like it fits perfect for what you guys target.
Yeah, look, theme parks, they definitely fit. I think our strike zone, if you will, is if you think about what is a unique experience, typically a entertainment, recreational, leisure, or sport-related experience that really can't be conducted within your home or can't be Amazon delivered to your home.
Ed says that on every call
we
here.
We like to say that.
I love it. Yeah.
And that to us, that's what makes something experiential. COVID was a great proving ground for the thesis of, well, if people can all of a sudden start ordering all their groceries from home and stream everything and do all these things from their home, do they really need to travel the way they used to? They can Zoom for meetings, but do people really need to be together? Do they need to be out of their home to seek entertainment and recreation and leisure and all these things? And I think, COVID was a question mark. The post-COVID was the proving ground. Right? I think if you look at all the key experiential categories, gaming included, the post-COVID era has suggested that absolutely people seek shared experiences for unique people want to be together. People want to gather together, and they need places to do it.
Right.
And our thesis is that operating businesses that are truly the folks that are creating those experiences, so long as they're location-based, real estate's involved. And if real estate's involved, it begs the question of, well, does that operator who's putting a lot of capital into facilitating their experiences and building the destination that they want, do they need to own it? Right? Do they need to own that physical real estate? And if they don't, and the answer in our structure is typically they don't, because we don't have any real controls over what they do with the property so long as they conduct their business. We are a way that operator can free up a significant portion of their balance sheet, and probably at a much lower cost of capital than they could do on their own, because we're investment grade balance sheet, we're big and diversified, we have access to the public markets, debt and equity, and theoretically that should be able to deliver cost of capital for the real estate, for the physical plants, that they can't achieve on their own. And it's sort of with that thesis that if you believe that the consumer is continuing to allocate more and more time and wallet share toward spending on unique experiences, that you're going to have a growth orientation to any of the operators in this space. And if there's a growth orientation, there's a need for capital. And if there's a need for capital, there's always going to be an interest in pursuing the lowest cost options.
Absolutely.
That's sort of where we come in.
So that leads me to a bunch of different questions, but the first one being, for you guys being a REIT and having this much exposure and like the brands that you have outside of obviously the biggest casinos and the most premier casinos in the world, like Great Wolf Lodge, everyone, if you have a family, probably recognizes that name. Canyon Ranch, these just premier brands that you guys have. I'm sure that helps a lot with the conversations, but is there a competitive advantage to essentially your financing or you're functioning as a bank for a lot of these operators? Is it a big competitive advantage, just this structure that the operator sees you guys having as opposed to them just going to a bank to get the financing and still holding on to this very clunky, not clunky asset, but clunky in that, like clunky on the balance sheet? It's so expensive, right? Instead of leasing it back. Like, is there a big competitive advantage for you guys being this powerhouse with the brand and then having done it as opposed to them having to go to a bank to do it too?
Yeah, I think there absolutely are competitive advantages that we see in practice, that some of our tenants or the folks that we engage with in the market say, gosh, what you guys can do is very different than the banks that I talk to. And I think it's the devil's in the details. There's some situations where that won't always be the case, and others will be the case to an extreme. I think when you're talking about sale-leaseback capital or development financing with a path to converting a loan into real estate ownership for us, typically what we find compared to traditional banks or the institutional debt markets, if you will, whether it be CMBS or high yield or leveraged loans, is that we typically can lean into leverage levels a little bit more than traditional lending sources, meaning we can provide a little bit more proceeds against an asset or against a cash flow stream than other sources might. And some of that comes with the security of owning the real estate and the security of a 20, 30, 40-year lease. But a lot of it is sort of categorical and operator specific underwriting, and us being sort of experts within our categories.
Yeah.
And when you take a level of expertise and underwriting comfort to something, you might be able to take a little bit more risk, leverage wise or proceeds wise, than traditional financing sources might.
Yeah.
And so that's often what we find. Now, what's interesting is if you go back a couple of years, our pitch to a partner would have been, we can provide a lot of capital. The cost might be more than what debt might cost you, but if you blend it with, if we're providing more capital, then we're subsidizing how much equity you'd need to put in, and you blend it, we should be a cheaper all-in source of capital, which was true. You fast forward to today, borrowing rates, if you're CMBS borrower, probably up 200, 300 to 400 basis points all in from where they were 2 years ago. Leveraged loan market, high yield market, very similar.
Okay.
Even us as an investment grade issuer today, we issue at 250 basis points higher than we would have a year and a half ago. So debt rates have all gone up. Our cost of capital hasn't gone up nearly that much. It certainly has gone up, but not that much. So what it means today is that the cost of our capital to our counterparts might actually be less than their cost of debt, and if the proceeds are more, it's a much more compelling component of their capital stack, whether it's a single asset or a broader portfolio, as part of a company. So financing wise, it's actually quite a compelling instrument in today's market.
So that kind of leads me to the next thing, which is like lease structure. A couple tangents to go on here, but how, because the lease structure really, let's say you're buying the property, the lease structure of what you're kind of paying for the asset, essentially the cap rate, it seems like. It's like, okay, hey, if we're going to earn 8% on this, it's just an 8 cap. And I'm sure underwriting them is very complex on the operating side. But like for you guys, it's, triple net lease. How much strategy goes into pricing these leases? I know there's kind of like the standard 1% increase, and then maybe after 15 or 10 years, it goes up 2% or CPI. Are there other levers outside of that as well? Because it seems like you can kind of value the asset well, but then there's just a myriad of different ways to structure these leases, and they're such big assets that every little nuance could be a considerable amount of revenue. So how does that work?
Yeah, that one of the learnings I've had since coming to VICI and obviously getting much more into the details of structuring new investments. One of the learnings I've had is just how much depth and nuance goes into a new lease or an acquisition of an asset. But what is not a new learning is that ultimately, economically speaking, there's really only 2 levers that we focus on that can really drive economic value to us. And that is our day one yield, or our cap rate on an investment. And then number 2 is our escalators in our leases. Those really are, that's how we make our make our return. It's what's our return year one and what's our return over time. And so in today's environment, no question, cap rates have gone up, funding costs have gone up. We're not immune to that. And so, we've had to adjust accordingly. So cap rates are a bit higher. What's interesting is on the escalator side, our company was formed via a bankruptcy settlement, and the lease, the master lease between VICI and Caesars, was negotiated between the creditors, the creditor groups, and lucky for us, we can't take any credit really. That original lease with Caesars was structured with annual rent escalators that were based on CPI without a cap. So that meant that if CPI went up 8.1% like it did in 2022, our lease with Caesars went up 8.1%. That's very uncommon in the world of triple net leases. Typically, they're fixed escalators or CPI with caps. In Europe, uncapped CPI escalators were more common, but they won't exist anymore. You have to be in places like we did. Especially that deal working out in 2017 and going through these last 4 or 5 years. It's like the perfect time to play that bet. Granted, you're saying it was already in place, but that's insane. Yeah, I'm sure they did. They will recorrect that curve, so to speak. As far as getting new deals and working on this white space, is there anything, well, obviously everything's more challenging right now, but like for you,
in this current market, how are you guys strategizing right now? Everything's so difficult. Is it more like maybe pivoting to lending as opposed to buying a new asset? And obviously you're in the golf business as well, but like, what's the focus on? Buying a new property leaseback, or doing more of this Canyon Ranch where, I don't know if it was more strategic in that. I guess to take a step back. So for Canyon Ranch, you approached them as this long-term partner and just kind of gave them financing, but you guys don't own either of the assets, right?
Not yet, but we will. Yeah, it's a good question. So I think to address your first question, which is how has our investing strategy evolved in the current environment? Then I'll come back to your point of just how do we actually go about targeting an investment. So what's evolved? I'd say the math that I sort of walked through a few minutes ago about how our cost of capital is still compelling today is absolutely true.
Sure.
But like any other environment where there's a sudden shift of pricing, cost of capital, M&A markets, these sort of things tend to slow down. Right? Sellers are slow to react. Right.
Right.
It's always a lag.
As they want to.
So so it is it isn't the easiest environment to be doing lots of big deals like we did a couple of years ago. But on the flip side, it does present an opportunity, to your point about lending. So we have ratcheted up our lending book. When we lend, we're trying to accomplish one of really three things. One, we're lending to eventually own, not in like the predatory shark loan to own kind of a way, but we're loaning typically to help finance the building of a new property that we eventually will convert into a prearranged OpCo, PropCo, or sale leaseback. So that's kind of goal number one with lending. Where can we do it where we can eventually own the asset? Goal two is where can we use lending to just get us into new categories? So we're well established in casinos, but what are the other adjacent categories we want to be in where lending is an easier step in that direction? And then three is, given where rates are today and where the prevailing market yields are for leveraged loans or mezzanine loans or things that have a little bit more riskier in nature, there's some really, really juicy yields to be had. So we're doing some projects, some of which are construction relation and some are not, but just where we're investing in categories that we're already in, including gaming, where there's just opportunities to get low teen or low double digit type of yields. Not doing a ton of that. We have about $2 billion of loan commitments today. A little bit more than that. A little bit more than half of that's funded. So out of a $50 billion balance sheet, we're talking about a small minority of our business. But in a time of uncertainty and transitional lending environments and trying to figure out steady state and cost of capital, lending is a way to sort of bridge to the other side and still deploy capital. So we're doing that. As far as how we go about our business development efforts or finding opportunities. The thing that you need to understand about really what we target within this world of location-based experiences that can't be Amazon is that we really are focusing on the types of assets that are what we call non-commodity. Assets that are unique, typically purpose-built, which isn't usually that isn't the typical real estate investment framework, because
usually not.
Usually you want to own something that is just, if it's well located, if Dollar General goes out one day and you want to put a Rite Aid in or a KFC or something else, you can swap. That's not really our approach. We'd rather underwrite an operating business that that sort of delivers something that we feel is unique, that has low cyclicality, low secular threat, has a durable experiential component to it that can't be disintermediated by Amazon or other competition. And generally what that means is we're looking at properties that are just different. They're bigger, chunkier, more unique. Not everything, but for the most part. And so what that typically means is that our type of financing, our approach is not something that they wake up in the morning thinking about. Right? We're not, our opportunities don't really come from brokers. They don't really come, we're not in the liquidly trafficked markets. We're in the capital solutions business, and we're going to the operators, to the businesses, to the categories that we like, and we're trying to find a way for our real estate capital to attach to their business. So it's much more of a self-generated, thesis-driven approach as opposed to flow investing.
And in a way, obviously, there are less, 200. There are much more 200-300 unit apartment buildings than there are potential customers or deals for you guys to buy, right? So
Yeah.
I assume you're making some of those phone calls directly, or someone on the acquisitions team here is. It's probably a lot more personable than this high frequency broker business.
Yeah, look, it's really we talked about it earlier, but in this business, it starts with a relationship. Yeah. I mean, we are relationship capital at market pricing.
Yeah,
that's one way to think about it.
So before, and if you want to, we can. I do it. You typically on each episode highlight a deal. It could be from Goldman days. It could be from here. But before we get to that, two questions kind of that parlay the end of that. So as far as underwriting and then time frame of a deal, something that's hard to grasp, right, when you're buying and transacting these large assets, or you bought the other half of MGM either at the end of last year or at the beginning of this year from Blackstone, from BREIT. I mean, it seems like these deals happen pretty quickly, which is very hard to understand, but how is the underwriting done? How long are these deals taking to underwrite, and what is the process? I guess the only part that I can make sense of is maybe from the operator side, it's harder to underwrite because you're counting every air conditioning unit, your cost per room, and maybe from your side, it's just, like you said, the two numbers. But like, what goes into underwriting these large assets, and how are these deals coming about? Like, how long does it take for the deals to happen?
I'd say the typical gestation period for a deal for us from conception to an announcement on average is maybe 9 months.
But that seems crazy.
Long. It's very long.
Seems fast in a way for how big these deals are, though.
Well, look, things like the corporate mergers, like MGM and even the Venetian, like those were in the context of public company processes with bankers and things like that. So I'd say in the ones that are driven by a marketed process, whether it's an investment bank or a broker or something like that, it can definitely be shorter. It can be a lot shorter than that, no question. For the ones that are more purely relationship driven, and hey, we've established a relationship with you as an operating business, and when you're ready to need our capital, whether it's to finance your next development or to finance an acquisition with you, then it's sort of we're here when it's time, and you got to dictate to us when you get your entitlements and when the time is, and those can take years, literally years. So we're always somewhere on that continuum with something. If it's a 2-year process, maybe we're at the beginning, maybe we're at the end, but we got something else that we're working on, and we're trying to get to a place where we've got some sort of capital deployment every month, whether it's in the form of an acquisition or in the form of funding a delayed draw loan. Trying to get ourselves into more of a programmatic, metronomic type of investment cycle.
Sure.
It will never fully be that way because when you do $1 billion transaction here and there, it tends to make things chunky, and that is how we've grown, is through chunky investments, but that's evolving.
Yeah. Wow. So last couple bits or segments here, so to speak. Is there any deal, complex acquisition, partnership, maybe in your Goldman days or here, that stands out to you, or a story to share in that regard? Any significant deal you worked on?
Yeah, let's, why don't there's a few things, but maybe I'll talk about the VICI formation, because it is such a fascinating time. There's a whole book written about it.
I read the book. Jason gave me the.
Done your homework.
He's like, read this book before you meet Kellan. I'm like, man, okay, all right.
Turns out it's a pretty good read.
It is a really good read.
Yeah, Caesar's Palace Coup. We've got copies here, but you've already read it. That's great. It looked to me, in fairness, it's really about the Caesars bankruptcy, and VICI was a byproduct of that. So it touches on VICI, not all about VICI, but you get familiar with a lot of the personalities.
But it's insane
in the background. Yeah. But one of the most acrimonious and most expensive corporate bankruptcies in American history. Yeah. And we were and I'll tell you the deal that we'll get to, but we were we were a little bit of the phoenix that kind of rose from the ashes. Yeah. Because VICI was really created as almost a life raft for like equity hope notes for the junior creditors. Mm-hmm. It was a place to park a bunch of debt. Yeah. When Caesars, the OpCo out of Caesars Entertainment Operating Company was kind of coming back with $10 billion less debt on its books. Yeah. Some of that was extinguished, but some of it had to go somewhere, and that's So VICI was set up in a way that wasn't necessarily reflective of what we've become, which is a growth vehicle.
Yeah.
We were not really set up to be a growth vehicle. But in order to become a growth vehicle, we had to delever the balance sheet. And we also had to prove that we could actually grow. We had to prove that there were acquisitions to be had, that we could match fund, accretively through raising equity.
Yeah.
So my first involvement with VICI was their first transaction ever, which was a $2 billion term loan refinancing in December of 2017. So they merged from bankruptcy. Caesars did in October. VICI was formed then, October of 2017. The IPO came in February of 2018, but in between there was a $2 billion term loan offering that we led back at Goldman, and an acquisition of Harrah's Las Vegas on the Strip. So it was a sale-leaseback, which was in part financed with a $1 billion equity private placement with some of the existing creditors that were the shareholders of VICI. And this was all happening in this flurry of time when, we literally were counting the days. VICI was on day 42 when the dialogue started with Caesars about the sale-leaseback. And then on day 59, we were in the market with the term loan. And day 53, we had the credit rating. It was very compact. And this was in December, right? You're even getting into the holiday season. And, but what came out of all of that was really the first acquisition by VICI being the third of the gaming REITs to be formed.
Yeah.
The first acquisition that a gaming REIT did were the company was speaking in real estate parlance. So everything until then, the gaming REITs that existed, MGM Properties and GLPI they were talking about multiples, and they were talking about traditional cash flows and gaming kind of speak. But VICI was coming out as a real estate company. Think about us as an investor in real estate at yields and cap rates, and we're buying Harrah's at I'll be misquoted, but probably a 7.1 cap rate, 6.9 cap rate, something like that. And why is it that we can be buying Las Vegas Strip real estate at that type of cap rate when
you buy a Dollar General at a
you can buy Dollar General at a 4 cap, or even the retail shops, the Forum shops or the Crystal shops on the Strip are going at 3.5 caps, and so there was a sort of this mispricing of an asset class, and so transaction wise, deal wise, for us, at least at Goldman at the time, we were focused on the debt, so get the right credit, get the best credit rating possible.
Right.
But in order to get that, it helped that the company did an extra $1 billion of equity in private placement, and that was done because they had this acquisition of Harrah's Las Vegas lined up, and so it all sort of worked in concert to create the story, create this momentum that yes, this is an asset class that can be institutionalized. That yes, it is an asset class that truly is real estate. Let's start talking about it like real estate. Yes, it is a mispriced asset class, and if we can build enough momentum, get enough equity investor interest, we can over-equitize our acquisitions to delever this over-levered balance sheet, we'll call it that, and set the company up in a way that can have a chance to succeed. That was the segue that led to the company's IPO, which further delevered and sort of rebuilt the coffers and allowed the company to go out and do more acquisitions. So that those formative months, days and months, were all about the intersection of capital markets and M&A activity that sort of set the company up on a path to ultimately be successful. And it was that great leadership, and still does. Same leadership team today as the company had back then, and it's continued on a great path.
In a very innovative path, right? It seems like obviously you guys are pretty much the only one really doing it like this. And kind of one of the notes I had earlier was like, one of the deals I saw you buy was at like an 8 cap. I'm like, I just don't understand how these assets are this big and they're getting this much return on these assets. It's quite mind breaking in a way.
Yeah. Look, one of the things that's so unique about casino real estate is it's such a highly regulated industry.
Yeah.
That when you think about the traditional risks to commercial real estate, one of them in a lot of markets is just competitive threat. Somebody builds a new shiny office tower next to you. Tenants are going to want to go there.
Sure. Brings your price down. Yeah.
Yeah. Supply, same with retail properties. But you can't just put up a new casino.
Yeah, good luck building another Caesars.
Yeah, not just the cost, but just the regulatory and the licensing process. It's so you have this built-in competitive moat. Not to mention, what is a sort of a consistent consumer tailwind and as a leisure activity.
Yeah. So in wrapping up, what's next for you guys? Where do you see VICI going in the future? And I guess we already talked about that a good bit, especially with this white space just in asset class, but then also investment type too. But is there any deal that you guys haven't bought, and maybe the answer is amusement, but you haven't bought, transacted on, lent on that you want to, that the company hasn't done yet? So I guess what's next, broader vision?
Yeah. For us, it's at a macro level, it's about defining, strategizing, and ultimately penetrating that white space.
Yeah.
So how do we define it? What are these categories? We talked about the wellness industry, the theme park industry, entertainment, immersive entertainment, out-of-home family entertainment. There's leisure activities like bowling, like skiing, like golf.
Yeah.
There's the whole world of sport, right?
Yeah.
Sporting, and so if you were to pick a category for us that we're actively studying but haven't really deployed capital into, that you see there could be a lot of white space, is sports. So think about professional sports, stadiums and arenas to some extent are intriguing, but really sporting pure infrastructure. So think of like training facilities that I'd argue is mission critical real estate to teams, but also provide the real estate owner with real downside risk and lack of obsolescence risk that you might have with a stadium.
Sure.
MetLife Stadium is not even 15 years old, and people are saying it's maybe about 15 years old. People say it's getting pretty tired. Right?
Right.
So, the sporting infrastructure, and then we view that everything from professional down to university and even youth sports.
Oh wow!
So we're spending a lot of time in that space. It's not as it's a little bit more fragmented, right? You've got lots of different team owners, lots of different universities, lots of different youth sports complex owners. So it's harder to have programmatic capital with one group.
Sure.
But as a space, it's really intriguing to us, and certainly hasn't seen the type of opco-propco
model
capital or model like you've seen in a lot of retail, family entertainment, and casino. Yeah. So that's a space that we're studying very actively, which is very iterative. Mm-hmm. You gotta hone your thesis as you continue to engage with the market. Figure out where our model works, where it doesn't, how to tweak. Is it a sale-leaseback model that can work? Is it more of a long-term lending model? Yeah. So we're spending a lot of time thinking about that.
Wow.
Among other things. We're also spending a lot of time overseas. Our model today, we're in the U.S. and in Canada.
Yep.
Our mandate is to absolutely be overseas. There's tax.
Just gaming-wise too, or other experience
as well.
Okay.
Yep. For everything. There's plenty of investable opportunities, experiential in casinos in different countries in Europe, and Australia, New Zealand, and some of the Asian countries. But we're spending a lot of time just figuring out where we can take our model overseas, and where we can do so within the confines of a REIT where there's some tax leakage, but ways to mitigate it. So we have a very, very, very big mandate, I guess I'd say.
Yeah, a lot looking forward to. There's a lot going on the focus. Last question for you, and then before we wrap up, obviously thanks to our friend Jason for setting this up. I appreciate that. But so for you, going from Goldman, coming here, who were some of the people who helped you the most along the way? Any specific mentors, any people that you worked under, any managers, any couple folks that you think you learned the most from along the way or helped you in a pivotal way?
Yeah, a number of folks come to mind. I it's similar to how we talked about that bond with your clients gets kind of crystallized in the trenches. Right. The same thing absolutely happens internally. I had a gentleman that I sat next to when I was an analyst, and he was an associate, and I was an associate, and he was a VP, and I was a VP, and he was an MD. A guy by the name of Naftali, who's now the CFO of Royal Caribbean.
Wow.
And worked on a lot of things together, learned a lot together, was a mentor, is a mentor. I've had some other folks along the way at Goldman, and kind of follow them through here to today at VICI. I think it's a necessary part of anybody's professional growth is to identify those mentors and stick with them and try to extract what learnings you can, whether it's through osmosis or through conversation.
That's right. Or failure or success. Yeah.
Yeah.
I love it. I think that's a good wrapping point. Thank you so much for obviously having me here today. Thanks for doing this. Is there anything of the VICI story or your story that we missed, or any last things you wanted to say?
I think we've covered a lot of ground.
I think so too.
Done some great homework. So I think we've covered it all.
I think so too. Thanks for coming on, Kellan. Appreciate it.
Thanks for having me, Matt.